Welcome back to the deep dive. The financial markets have felt like a real roller coaster lately, haven't they? So many headlines can easily leave you feeling overwhelmed. But our mission today, as always, is to cut right through all that noise. We've been immersing ourselves in the latest market recaps, the forecasts, really meticulously pulling out the most important insights to help you understand what's truly happening behind those numbers. Today, we're going to unravel the major forces shaping the market. Everything from that surprising jobs data to the Federal Reserve's complex next moves and how global trade tensions are adding to the mix. What's the most compelling connection you're seeing right now? The thing that kind of ties all these threads together?
Yeah, that's a crucial question because right now the market is navigating a truly pivotal moment. I think the overarching theme is this growing tension between slowing economic activity on one hand and stubbornly high inflation on the other. It's like the economy is trying to cool down, but, well, some parts are still running hot. And that forces the Fed into an incredibly difficult position. That's really the core of what we'll unpack for you today.
Okay, let's dive straight into this week's market ride then. It kicked off strong, but then seemed to fade pretty fast. What was that initial economic shocker that sent ripples through, well, everything?
Well, what's truly fascinating here is what we discovered in the jobs data. You see, the July payrolls initially looked weak, okay? But the real punch, the real surprise came from the massive downward revisions to the May and June numbers.
The revisions.
Exactly. It means those earlier reports, the ones that looked stronger, they were significantly overstated. If you look at the revised figures, the 3-month average for job growth is a mere 35,000 jobs per month.
35,000, wow.
Yeah. That's only about 106,000 jobs added over the past 3 months total, revised down from nearly 300,000. It's a drastic change.
That significant slowdown. It sounds almost counterintuitive, maybe, given some of the other data we've seen recently.
Yeah.
For someone trying to visualize the impact, how would you describe the economy's vital signs now? Is there, an analogy that helps clarify it?
That's a great question. Think of job growth maybe as the economy's heart rate. If it's beating too fast, inflation tends to rise, right? And the Fed usually tightens policy, raises rates. If it slows down, the Fed eases up, takes the pressure off. So this new data suggests the economy's heart rate has significantly decelerated. It's signaling a notable cooling in the labor market.
Okay, that makes sense.
And the bond markets. They reacted almost instantly. They quickly priced in a 75% chance of a rate cut by September.
75%, that's a big jump.
It is a huge jump from just 45% a few days prior.
Yeah.
It just shows how sensitive sentiment is to any signs the labor market might be weakening.
Right. So, okay, the market is aggressively expecting these rate cuts. But here's where it gets interesting, maybe even contradictory. Didn't inflation data also come in hotter than expected last week? How does the Fed even begin to reconcile these two opposing forces, slowing jobs but rising prices?
This really does raise an important question, and it perfectly highlights the tightrope walk the Fed is on right now. Despite that clear slowdown in jobs, both core PCE, that's the personal consumption expenditures price index.
Right, the Fed's preferred measure.
Exactly. The one excluding volatile food and energy, and the University of Michigan's one-year inflation outlook, which is a key gauge of what consumers expect. Both of those surprised to the upside. They came in hotter than expected. So this suggests inflation is truly digging in its heels. It might stick around well into the autumn. And remember, we also had that Q2 GDP advance estimate showing surprisingly robust economic growth. That just adds another layer of complexity.
So it's not just jobs versus inflation, but growth is still looking okay too.
Kind of, yeah. This combination is the central tension. The DIY insight from our sources, I think, sums it up perfectly. They said, the market is stuck between rising inflation and falling jobs, a setup that could force the Fed's hand sooner than they want, but also into a more difficult policy decision. It's a genuine dilemma for them, no easy answer.
But it wasn't just the economic data pushing and pulling the market this week, was it? We also had pretty significant developments on the global trade front. That certainly added another layer of complexity. What were the key developments around Trump's tariff agenda, especially with that August 1st deadline looming?
Right. We saw some pretty aggressive moves, and they were quite diversified across different areas. The EU, for instance, they managed to secure a reduced auto tariff rate down to 15%. Mexico received a 90-day extension for negotiation.
Okay, so some negotiation there.
Some, yes.
Right.
But other sectors weren't so lucky. Copper goods were slapped with a hefty 50% import tariff.
50% on copper. Ouch.
Yeah. And pharma companies were given a 60-day ultimatum, cut prices or face sanctions. So pretty direct pressure there.
These aren't just abstract policy moves, are they? They immediately ripple through industries. I mean, that 50% tariff on copper goods, that will directly impact manufacturing costs here at home, won't it? Which could then show up in higher prices for consumers eventually.
Absolutely. It adds a tangible layer of complexity for businesses and, like you said, for the Fed trying to manage inflation.
And speaking of the Fed's tightrope walk, we also saw a significant development that adds, well, a new dimension to the political pressures they're facing. That surprise resignation of Fed Governor Adriana Kugler, effective August 8th. What's the significance of that departure right now?
Yeah.
Especially given the FOMC minutes just revealed a split committee.
Yeah, that's a crucial point. Kugler's departure opens up a seat for a new appointment, and that potentially allows for, well, political pressure to reshape the Fed's future composition and its policy direction down the line.
More uncertainty.
Exactly. It adds another layer of uncertainty, especially because, as you mentioned, the July FOMC minutes revealed this split committee. 2 members actually dissented. They wanted a rate cut now.
Really? 2 of them?
Yes. So you have a Fed that's already internally divided on policy, facing this persistent inflation, and now a key member is stepping down. It creates an opportunity for external influence,
So let's pull this together. We've got weak jobs data pushing for cuts, hot inflation pushing against them, new tariffs creating uncertainty and maybe higher prices down the road, and now a politically charged Fed resignation. How did the major market indices actually react by the end of the week? Did people panic, or was it more nuanced?
The market certainly pulled back, but I wouldn't call it a full-blown panic. Not yet, anyway. The S&P 500 was down 2.4%, the Dow Jones fell 2.9%, and the Nasdaq saw a 2.1% decline. So broad-based selling.
Okay, and bonds?
The 10-year yield, which, is often a barometer for economic expectations, and it influences everything from mortgage rates to corporate borrowing, that fell 14 basis points to 4.2%. To just maybe rising growth concerns or rising rate cut expectations or both. The U.S. dollar index, the DXY, also saw a strong push earlier in the week before slipping back a bit on Friday.
Okay. And what about overall market sentiment? You mentioned not panic, but how did it feel?
Well, the Fear and Greed Index, which tries to gauge how greedy or fearful investors are feeling, it dropped sharply. It went from 78, which is considered extreme greed, all the way down to 50. That's neutral territory.
Wow, 78 to 50 in just a week.
Yeah, it's a pretty swift shift in just a few days. It's almost like everyone had a wild party last week and woke up with a massive financial hangover this week. So while overall market prices are holding, sort of, the internals aren't great. Things like breadth thinning out.
Meaning fewer stocks are participating in any gains.
Precisely. Fewer individual stocks are actually driving the market, suggesting less broad strength. And we saw weak volume on the down days, too. That all suggests caution. So, like I said, not a panic move, but it's definitely not as greedy as last week.
And it leaves the market at a crossroads, really. Either the bulls step up and buy this dip again, like they have before, or, well, we could be looking at a more serious correction. Okay, let's shift gears slightly from the macro picture. How are individual companies holding up amidst all this uncertainty? Earnings season was in full swing, right?
Right.
Especially for the tech giants. Were they showing like uniform strength or weakness, or was there more of a divergence there?
Yeah, tech earnings were indeed mixed. And that's actually where some real insight lies, I think. You had Microsoft and Meta often seen as bellwethers for enterprise spending and digital advertising. They delivered pretty bullish results, even saw breakouts in their stocks. That suggests businesses are still investing in technology, which is a good sign.
Yeah.
But Amazon and Apple, which are generally more sensitive to consumer discretionary spending, things people want but don't necessarily need, they posted weaker than expected numbers. And that put a bit of a damper on the whole sector's momentum.
Okay, so it was split.
Exactly. The key takeaway here seems to be a divergence. Enterprise spending looks resilient, maybe, but the everyday consumer, they might be feeling the pinch of inflation more, and that's a critical signal for overall economic health, isn't it?
Yeah, absolutely. That's a fascinating split. Were there any other notable corporate stories that stuck out, particularly maybe around those tariff discussions we mentioned?
Oh, absolutely. On the global consumer side, you had Puma specifically warning about the impact of tariffs and slowing demand from China. But then you had others like Heineken and Stellantis, the automaker, kind of downplaying trade fears, suggesting they felt maybe more insulated.
Interesting.
And luxury goods companies like Kering and LVMH, they actually helped cool worries about an upmarket consumer pullback. So some segments of the consumer market are still looking robust.
So again, a mixed picture even within consumer stocks.
Very mixed. And then industrial and transport companies, think Ford, UPS, Old Dominion Freight Line, they gave generally neutral views on the trade impact. Suggests it's not a universal hit across the board.
Okay. And any other major corporate news?
Yeah. Beyond trade, we saw some significant M&A action, mergers and acquisitions. Union Pacific is acquiring Norfolk Southern for $85 billion. That's huge in the rail industry. And Palo Alto Networks is acquiring CyberArk for $25 billion in the cybersecurity space.
Wow, big deals.
Yeah, they signal consolidation in those industries. And it shows that even in these uncertain times, companies are still looking for strategic growth opportunities. They're making big bets.
Okay, so bringing all these threads together now, the macro picture, the company specifics, what does this complex setup mean for the week ahead? What are the top 5 things we're watching this week that will likely keep investors on their toes?
Right. This is shaping up to be probably one of the biggest weeks of the entire quarter. A lot is happening. First, you've got the Fed shakeup fallout, Governor Kugler stepping down, and that persistent market pricing of a 75% chance of a rate cut in September after the jobs miss. We'll be watching how that whole narrative evolves.
Okay, Fed in focus, number 2.
Second, tariffs in focus. We're getting new trade balance data and factory data this week. That will allow us to start assessing the real-world impact of those recent tariff moves we talked about. Are they biting yet?
And what about that sticky inflation, the thing that's, still a major concern for the Fed?
That's number 3. Inflation signals heat up. Investors will be watching PMI data, that's Purchasing Managers Index data on Tuesday, and the New York Fed's inflation survey on Thursday. These will give us fresh insights into whether inflation is indeed entrenched, potentially forcing the Fed to delay any rate cuts until October, or maybe even beyond September.
Right, delaying those cuts the market wants so badly. And earnings.
Earnings season continues to roll on, absolutely. That's the 4th point. A huge week for earnings.
Mm-hmm.
We've got 122 S&P 500 companies reporting. This includes heavyweights like Palantir, Eli Lilly, Disney, AMD, also DraftKings, Shopify, Pfizer, Uber, a real mix.
That's a lot of big names.
It is. And these results will be a crucial test of how companies are really holding up in this environment of, sticky inflation and those rising tariff concerns.
Okay, makes sense. And finally, number 5. What else should we keep a close eye on?
The 5th key area is continued tech, oil, and M&A watch.
Yeah.
The mixed tech earnings, that whole divergence story, will continue to be a theme. We'll be looking for clearer trends there. Oil giants like Exxon, Shell, Chevron, they're emphasizing output growth, which could impact energy prices, so that's important. And those massive M&A deals we just discussed, they could spark more buzz, maybe more consolidation across various sectors. That creates both opportunities and competitive shifts.
What's the actionable takeaway from all of this? This feels like a lot to digest. We've seen the market grappling with, notably slower job growth, surprisingly persistent inflation, a Federal Reserve showing a clearly divided committee on rate cuts, and these escalating global trade tensions that are now clearly impacting corporate outlooks. It's a complex picture, no doubt. Yeah. But hopefully this deep dive has given you a much clearer lens to understand it all.
Yeah, that's the goal, right? The key takeaway for you listening isn't just to absorb the facts, but to appreciate that there's always more to learn. Critical thinking is just essential in this world of information overload. I think the significant job revisions, the market's aggressive bet that 75% chance for a September rate cut that the Fed might be reluctant to deliver, and that dramatic shift in the fear and greed index from extreme greed right down to neutral, those are really the essential nuggets for this week.
It's not just isolated numbers.
Not at all. They collectively paint a picture of a central bank genuinely caught between a rock and a hard place, and that inherently creates volatility. It signals this potential tug of war between what the market expects and what the Fed might actually do. That's the defining tension, I think, for the next few weeks.
Right. This isn't just about knowing the facts. It's really about understanding those ripple effects, the underlying tensions, and how they might play out.
Exactly. If we connect this to the bigger picture, the market is navigating a truly pivotal moment, one that demands a really nuanced understanding.
So as you reflect on all this, maybe consider this question. With trade tensions still simmering and Fed policy very much in focus, how do you think these factors will influence market sentiment in the second half of, say, 2025? Will AI and tech stocks continue to lead the charge? Or will these tariffs and geopolitical risks create significant headwinds for broader economic growth? Something to mull over until our next deep dive.